Hi, everyone. I'm Maggie Lake talking markets today with Noelle Acheson, author of the Crypto is Macro Now newsletter on Substack. Hi, Noelle.
Yeah, Maggie, so good to be with you today. Hi, how are you doing today?
I am okay. I am sort of I feel like every time I come in on a Monday, I'm bracing myself because there is so much going on. And you just know the weeks feel longer than 5 working days. So today I feel like it's coming, but we are, I think, waiting, right? In wait and see mode. The Dow did hit a new record. US stocks a bit mixed. The Dow hit a new record, S&P flat, NASDAQ down. And it seems like everyone is just waiting for this Fed decision that we're going to get this week. And there's, I think, general consensus they're going to ease, but by how much, I guess, is the question. Is that your feeling?
Absolutely. And I have never seen this much uncertainty going into the FOMC meeting before. We've seen the uncertainty flip flop as the meeting approaches on the calendar, but we're 2 days out and it's like 60-40 between the 50 and the 25 base. I've never seen this level of uncertainty. And that's a very big deal for markets because now, whatever the FOMC decides, there's going to be a lot of people that are very unhappy. And what do they do to their investments? How do they react to the news? It's a very strange situation to be in. The market was a lock for 25 just on Thursday night. I remember writing
Mm.
about that and then shutting off for the day. And I come back on Friday morning and it's totally flipped because of a couple of articles that appeared, one in the Wall Street Journal and one in the Financial Times, written by people who do have very good contacts at the Fed. And both were saying, the Fed hasn't decided. It might be 50. And we're
Mm.
like, what?
Yeah. And I know a lot of people are kind of irritated that it seems to be coming out in leaks, just kind of questioning the communication policy of the Fed, which is, I think, fair. Uh, how should we be thinking about these interest rates? Because we have been in this situation where everyone's welcoming them and thinking this is a good thing, but that kind of defies logic in a way. I guess talk to me about your thoughts around that. I mean, the good thing is, I guess, more liquidity is coming, which should be good for risk assets, but is it that straightforward?
Is liquidity coming? That's the underlying question. I think that these interest rate cuts are going to be excellent for sentiment, and to be honest, not much else.
Mm.
One, housing is the area of the economy that really needs some stimulus, and there's going to be a lot of cuts needed to get the housing market going again, given where the bulk of the mortgage interest rates are. A lot of people are simply not going to be refinancing at these higher rates. And the rest of the economy is just not screaming for that kind of an action. And inflation, in my opinion, is not totally behind us yet. There's a
Mm.
very strong risk that we will see inflation come back, especially if we get another Trump administration in the White House. That's a different discussion. I think it's sentiment because on the way up, the rate hikes didn't affect liquidity very much. Financial conditions, according to the Chicago Fed, are as easy now, as loose, as before the Fed started hiking. Even if you just look at credit, credit is as loose now as before the Fed started hiking. And so the interest rates didn't do much to credit, which is supposed to be how they work. They
Mm.
hike, people borrow less, and inflation comes down. Well, that isn't why inflation came down. We're not quite sure why it did, but it wasn't because credit dried up. It wasn't because spending dried up, and it wasn't because everyone lost their jobs. So there's another thing going on here with inflation, which does suggest perhaps that the rate cuts are also not going to have the impact on bottom lines that people expect.
That's so interesting, which upends the whole sort of way we're thinking about this. So let's take a step back. If we're not sure about the impact on inflation, and by the way, the Fed's been on the record for a long time saying they don't really fully understand the dynamics of inflation because there is so much psychology in it. Um, should they be cutting 50? So the leaks are what changed it, not necessarily the data. And in fact, we got a pretty strong regional reading here in the U.S. from New York. Yes, it's volatile. It shouldn't be looked at on its own. But does the economy suggest the Fed should go 50 in your opinion?
Absolutely not yet. And I have been in the camp that we are going to be getting a recession at some stage, or a slowdown at the very least. I used to be in the recession camp. I realized my timing was off. So now it could be a slowdown because the economy is moving in two different directions. We do have manufacturing slowing down. We have services still going very strongly. And yes, we do have unemployment edging up, and this is what the Fed's pivoted to focusing on now. It's not so much inflation. Who cares about that? That's done. It's the unemployment they're worrying about, but it's edging up ever so slightly. You blink and you couldn't even really see it.
Mm.
And it's still very, very low. It is lower than the pre-crisis average, for instance. So there's not a lot of reason yet. Yes, unemployment moves fast when it starts moving, but arguably the unemployment has started moving not necessarily because waves of people are losing their jobs. Employment itself is actually continuing. It's just the employment mix, the working population mix has been changing. So I have a fly dive bombing me while we're talking here. That's going to come up on the video, I'm sure. But so should they? No, I don't think they should, simply because inflation is not licked. And again, they imagine, Maggie, that they have to start raising rates come March or April next year. The damage that that would do to the reputation of the Fed, which would impede its ability to fix problems that are going to rise in the future. Well, that would be very hard to correct.
Yeah. I always feel like when that happens, Noelle, it's just like the spirit of Jay Powell chasing you around saying, don't question what we're doing.
Exactly. Stop saying that. I'm going to dive on
Exactly.
you. Stop saying that.
It has a way of happening, right? So when if that is the case, and we're talking about an economy that looks pretty solid, and yet the Fed feeling like they need to leak the idea or trial balloon the idea that they're not really decided, it's a live meeting, right? That's what they say. They're going to be discussing it in time. If they do go 50, should people think, oh, well, the Fed's getting ahead, or what will you think? Is the Fed getting ahead of it? Maybe they're trying to not be reactive for once and be proactive and cushion the economy from maybe a harder turn post-election with some of the uncertainty? Or should we be scared that they know something that we don't?
That's a possibility. We saw the Beige Book, which came out recently, and there were a lot of rumblings there about some not very happy employers as well as employees in the various regions in the regional districts of the Federal Reserves. That is a hint, and it could be, yes. However, if that is the case, Maggie, if that is the interpretation, should they come up with 50, then what does that do to the market? That's got to spook it a little bit, right? So here we have, again, we don't really know. It's a coin toss between, does the market plummet because they're worried about what the Fed knows, or does the market rocket because, yay, more liquidity? Although, as we talked about, I don't think that's really going to happen. What is interesting this time, I've been making fun of the Federal Reserve speakers, with a lot of respect, obviously, by the sheer volume of talking that they tend to do. Back in the June, May, it was just talking all the time. I don't remember ever seeing so many Fed official statements. We haven't seen that over the past few weeks. Obviously, they've been in their blackout period for the past 10 days, but before that, there's suddenly less. And the Biden nominees, other than Jerome Powell himself, they haven't been saying anything for like a month, which is weird. And the Trump nominees, they are cautious. They are cautious at the moment. And so you do also have to wonder, and I'm not inferring anything here because I know the Fed is not political, you do have to wonder what some of the incentives are. I personally do think the Fed is not partisan, but maybe it's a bit political.
Yeah, that's a great distinction. Because it gets lost in the when people sort of go too far into the partisan one team or the other, it seems improbable and just sounds like noise. But the idea that you can be political without choosing a side, but understanding what Washington as a whole, the pressure of that is I think a really, really smart distinction, Noelle. So I just want to take a second, and I'm looking over reading the chat. It's great to see everyone there. Oliver and Paul. Hi, I see some of the regulars reconstituting. Thank you for that. J&J asking, Noelle, if you don't think the Fed, that rate cuts would bring more liquidity to risk assets, what would be needed to raise the liquidity tide from here? I think that you're saying that things are already liquid. Is that right?
Yes, I am. And do we want to raise the liquidity tide from here? The market has had a phenomenal run this year. Imagine what an influx of liquidity would do to valuations. Imagine what it would do to set up some of the leverage that we know is going to add fragility. What I'm worried about, seriously, is not so much what happens the rest of this year. I think markets are doing quite well. I do expect a strong correction soon. What I'm worried about is the introducing more fragility into the system. Leverage overall in the system is not at eye-watering levels like we've seen just before previous crashes. What if it gets there because suddenly credit is easier and liquidity is finding its way back in? Right now, the market has been increasing, in my opinion, in some sectors too fast, but it's been pretty broad based. Even given the rotation that we've seen, it's been pretty broad based. That's the best you can hope for, and that is hopefully what's going to prevent the kind of frightening crash that it ends up impacting politics as well as global markets. So do we want more liquidity to come flooding in, or is the amount that's already in the market, given the additional collateral from asset price increases, is that going to be enough to keep momentum going for the rest of the year?
It's funny when you say valuations. What would that do to valuations? I think plenty of people would love to see valuations go
Well,
skyrocketing higher. But
yeah,
you're right. Does it create the froth that then lays the groundwork for something to break, which is always what
exactly.
we were concerned about all along. And that, that concern, it goes away, but then it bubbles up when we see strains, right? And we saw that again in the summer, and then quickly we sort of saw that evaporate. If you haven't had a chance to, all of you, I recommend you listen, go on the channel and listen to the conversation I had with Jem Carson on Friday. He's, as Noelle is talking about, has one short-term view through year end based on some of the structural things he's seeing in the options and derivatives market, but has a much more concerned, I would say, bearish view going out into 25. Very concerned about exactly some of the things you're talking about, Noelle, the fragility that may come in a really, really uncertain period. And so it's interesting, we see these little pops of some strains in the system, and then they seem to ebb and everybody forgets about it. I wanted to ask you, you just said you expect a correction. Are you talking about in the US stock market?
I am, yes, because uncertainty is it needs a valve to release at some stage, and uncertainty is indeed very, very high. And I personally am very skeptical of the bottom line impact of AI in the short term. Long term, for sure. Short term, we're overestimating it, which means that the valuations of the large tech companies are somewhat overestimated as well. And when they start to turn down, given that they've been responsible for much of the upswing, then that could be very ugly. Mercifully, and I didn't expect this, and I'm delighted to see it. Mercifully, we are seeing some valuations of consumer stocks and some of the more boring opportunities in the market. They have been doing pretty well. I think I read this morning, and I haven't had a chance to check it, so do fact check me on this for sure. But Walmart's valuation is now higher than some tech. This is Walmart we're talking about. That's consumer. But this goes back to what we were talking about before. Isn't the consumer supposed to be really suffering here? And isn't that why inflation has come down? We're just not seeing it. Yes, we're seeing it in anecdotal reports. Yes, we have heard earnings reports from many of the big consumer companies saying that we're seeing margin squeeze. We have seen people shift to cheaper prices. But that's not necessarily the crash that people had been waiting for to justify strong interest rate cuts. We're just not seeing that. And I hear the argument every now and then, Maggie, that they got to bring interest rates down fast because real rates are so high and that stuff. Real rates aren't that high. I mean, I don't know where people get this idea from. They're very high relative to the inter-crisis period between the great financial crisis and the pandemic. Yes, they're high relative to that period, but we can argue that that period was not normal. Real rates right now are at the low end of the range leading up to the great financial crisis, and heading into the great financial crisis, real rates were at the time coming down anyway. So again, real rates I don't think are the issue. Sure, they can come down a bit, but not nearly as much as the market seems to be expecting. And then the next question, Maggie, is what happens if indeed we do get 50 on Wednesday? We get change in the White House. There's tariffs, there's labor force shrinkage through deportation of immigrants, there's tax cuts, inflationary policies, and the market starts to realize that they have been totally overestimating the resilience of the cooling of inflation as well as the end target of interest rates. What happens when those expectations get unwound at a time we have Japan starting to raise interest rates? That could be really messy, and that's sort of the correction that I'm talking about.
Is it that related to the idea that you would see a lot of money repatriated back to Japan? That used to
Yes.
be, yeah, that was for years going into U.S. assets because Japanese rates were rock bottom or
Yeah.
negative, actually. So this is oh, we always come back, and we will, I think, to this. I think the core of what divides so many people who follow financial markets, and the folks in the chat today, we talk about it all the time, because there's so many good examples and sort of fundamentals to back up that view about the risk of reinflating, and that we're in a regime change now. We're moving away from that unprecedented period of very, very low rates. We're moving toward a higher rate environment. And then, of course, on the flip side of that are the people who think, well, there's all this government debt. They've got to slash rates again because they have to just, roll the interest. They just can't afford to have high rates. The governments would bankrupt themselves. So regardless of what happens, you're looking at a period of low rates, and you're just going to see everything, your borrowing power just eroded because of that.
Exactly. But the Fed's not political, so surely the Fed shouldn't care about that. But the Fed has to care about that, right?
Yeah. But how do you why do you think it's we're going to reinflate and be in for higher rates as opposed to the latter? Do you think the market takes things into their own hands? Is that the kind of missing bridge between how we would get there, even though from a governmental point of view, there's a need to have low rates?
Reinflate in terms of interest rates heading back up, the vigilantes will do that. And obviously bond yields are going to be very, very important, not just to be able to finance the flood of debt that's coming, because neither candidate has even mentioned bringing down the debt level or even curtailing spending. And if we are going into a world in which you have military alliances fragmenting, everyone's going to be increasing military spending. And if indeed there is a slowdown, and again, maybe not, but if there is a slowdown, then social spending is going to be going up. In other words, this is going to accelerate, and not just in the United States, but pretty much around the world. So you're going to have you're going to have to justify and somehow incentivize the purchase of government debt at a time you're competing with other nations, as well as other potential reserve assets, such as gold and perhaps some Bitcoin in the future when it becomes more accepted. So you've got that, and the rates are going to have to be higher. They're going to have to be higher. So that, combined with the liquidity issues that we are going to be seeing emerge in the market, what could make all of that totally wrong is strain in the banking system. We could see the Fed have to step in and help out some of the banks by doing something with rates, or if there is strain in treasury liquidity, there's some plumbing issues that they're working on, and the Fed would, of course, do what it needed to do, because you can't have the liquidity market, the treasury market seize up. You just can't. That's something. But as we saw in last March, there are many other tricks at their sleeve. They don't need to necessarily drop rates fast to be able to fix crises. Federal Reserve plumbing is just, as you know better than anyone, Max, it is so complex, but that also means there are so many different levers they can pull. So why would rates plummet unless it is to save the economy from an almighty crash? And if that is the case, why would assets rise? Why would assets climb?
Yeah, well, and that's the important part, right? Because people always say, well, the Fed can do whatever they want. We saw that once they started quantitative easing, and we both lived through that. Then the sort of toolbox of creativity was open, and there was something they can come up with. But the knock-on question is, that's fine, but what does that mean for assets? What does that mean for stocks? What does that mean for the economy? If they're doing that, then surely something terrible is going on.
Absolutely. And you asked about what would push the rates up again. Another thing to keep an eye on is the gold purchases. There's a huge, massive, apparently, I was reading about that from a Goldman Sachs report this morning, massive amount of undisclosed gold purchases from central banks, huge. More than we've seen over the past 2 years, more than happened in the previous 20 years, or something ridiculous like that. And so we are seeing, there is evidence of central banks shifting out of dollar-based reserves into more neutral assets such as gold. If that trend continues, then again, who's going to be buying the debt? It could end up being the American public through higher rates. They'd need to be incentivized, or it could end up being the Federal Reserve, which again is another kink in the plumbing.
Yeah. Yeah, a lot of worrying outcomes there. So we have some questions. First of all, Noelle did a deep dive on real rates and the whole rate issue in her newsletter today. It was fantastic. I encourage you to go check it out if you want to see some of her reasoning around all that. The other thing she talked about, which is what we're getting questions about right now, is Bitcoin. So and of course that ties into the broader issue we were just talking about, but just from a price action point of view, a lot of people are wondering what's going on, wondering why we've kind of been stalled here. Ape is asking, what is your expectation for Bitcoin in the next 6 to 12 months? Noelle, I should say, as you know, those of you who frequently follow or get her newsletter, covers across all of the markets, which is why we love the fact that she could be at that intersection for us. So we can jump to that discussion, but what are you looking at for
It is so
that?
interesting, Maggie. I mean, especially covering a wide range of markets. There's so many stories, and they're interacting increasingly with each other, which what makes this so confusing, but also just so rewarding to try and figure out where it's all going, what threads to pull on. Bitcoin is behaving very strangely. There is no two ways about it. It has so many tailwinds accumulating. It has the easing cycle, even if it's just sentiment, or even if there is more liquidity coming in, that's going to favor risk assets. It has a weakening dollar. That's supposed to be good for Bitcoin. It has the ETFs. It has the growing uncertainty in the world, which does support the safety narrative. And yes, Bitcoin longer term is regarded as a safe haven. It is a hedge against crazy economics and crazy politics, and also a hedge against risky banking systems. So Bitcoin has so many tailwinds at the moment. The headwinds are quite significant. I do think that the political environment in the United States is still a headwind, especially with Kamala Harris now leading in the polls. That's not the ideal outcome for crypto. I don't think it's terrible, but it's not the ideal outcome. A Trump victory would be better for the crypto ecosystem because of his very vocal support. Whether he means it or not is a whole other thing. That doesn't really matter. I'm of the opinion that Harris' victory would also be better for the crypto ecosystem than the Biden administration has been. Not nearly as friendly and supportive, but not as bad as we have seen so far. So either way, again, tailwinds. The regulatory chill will start to thaw. Bitcoin is right now suffering from risk uncertainty and the political uncertainty. And once those blankets start to thin, then we could start to see some moves, because it has underperformed the expectations this summer. That said, Bitcoin is smack dab where it should be if you're just tracking cycle movements. Forget about the narratives. Hard to do, I know, but forget about the narratives. Even if you're just tracking patterns, if you're a pattern follower, Bitcoin is actually doing fine. It is where it should be if you compare where it is from the bottom of previous cycles to the previous cycles. In other words, I was reading an analysis this morning about how it is much more interesting to compare where Bitcoin is from its bottom of this cycle, because that also gives you an indication of how long people normally take to get over the bear market mentality. You know, it's hard to shrug that off when you've been swimming in depressing waters for so long. Well, Bitcoin is, again, it's smack where it's been in the previous cycles.
So can we extrapolate anything from that? Does that give us any indication of where it's going? I don't know. It's
This
like a
is
new
math.
asset, like, people, we have, for all the other assets, we have so much technical analysis that will say,
Yes.
well, a retracement, the 200-day moving average will get us here. And, we
The
know,
resistance and the targets.
yeah.
And I'm going to
Can you
be
do that
totally
with,
honest with you. I don't really understand technical analysis. I respect it. I see it works, but I couldn't actually do that myself. But I did pull out my calculator and figure out now, if Bitcoin is smack dab where it should be in this cycle, and we compare where it could go using the 2016 and the 2020 cycles, then Bitcoin's by March could reach either $79,000 or $315,000. Take your pick. Obviously, one is
wow,
preferable.
that's a big range.
It's a very big range,
So
because also, the 2016 cycle was huge. The 2020 cycle was a bit more muted, and it's easy to soar from a low level. Bitcoin is arguably no longer at that same low level. So, I don't have any official price predictions, because I've learned to not do that. Obviously up, because of the very strong narratives and tailwinds behind it. But whether it's going to be up to 300 or whether it's going to be up to 100, that I don't know. I did, again, maths. I'm a maths major. Not everyone knows that. I love numbers. So I pulled out my model and I figured out what does Bitcoin have to increase per day to reach 100,000 by the end of the year? Someone had asked me recently, why do people keep making these ridiculous predictions for Bitcoin? No way would it reach 100 by the end of the year, because that's like tomorrow practically. And doing the numbers for Bitcoin to reach 100,000 by the end of the year, say that's 120 days from now, we'll give or take, it would have to go up by 0.45%. That's it.
wow.
So it's doable, and we know that when Bitcoin moves, it can move fast, especially given the new on-ramps, and especially given the amount of Bitcoin that over the past year has been socked away in longer-term addresses. Longer-term addresses are those that are just accumulating and they're not trading, they're not churning. So, and the thing that people obviously know, but perhaps don't fully appreciate, is that Bitcoin is the only liquid asset today that has, whose supply has no bearing whatsoever on the price. If gold were to shoot up to 100,000, you bet we'd be finding new ways to mine gold and the supply would increase. Whereas Bitcoin just does not, the supply does not care what the price is.
Wow, that's so interesting. I mean, Noelle, wicked writer and math major. I mean, of course I should not be
Thank you.
surprised. Of course I should not be surprised. That's fantastic. So Oliver wanted to know. Sorry, I'm looking through the I'm looking through the text. You guys are so funny. He wants to know what you're thinking about in terms of portfolio construction throughout the end of the year. I'm just going to posit that by saying that, of course, Noelle is not a financial advisor. Only you can know your own risk. We go through all this all the time, right? But generally, I'm just going to rephrase that slightly. I think it was Oliver who asked, by the way. My apologies if it wasn't. It was either Oliver or Paul. I think it was Oliver. I'm going to ask it a different way. Do you feel like you would be defensive and protective and really wanting to sort of be in a sort of preservation mindset heading into the end of the year? Or do you think that there are some forces, especially if the Fed's easing, that at least in the short term can kind of extend what we see before we really have to kind of climb into the bunker? Because I do know that you're a little bit more, it sounds like you're more worried, as we turn into the end of the year. But how are you feeling about the next few months here?
Defensive, I have to be honest. And again, this is not financial advice. I would be a terrible trader. Nobody should follow my trading advice ever. But for me, defensive, simply because things are dicey out there. It's not just the political uncertainty in the United States, the largest economy of the world. It's not just the possibility that we have a close election that the other party won't accept. It's not just that Europe has its difficulties, Japan's having difficulties, China, we don't really know what's going on there, but we do know that military tension is also ratcheting up, and it's just messy. And in times of messy, I go defensive because I don't want to have, the stomach clenching anxiety of having to check my portfolio every morning. So for me, Bitcoin, and this is not financial advice, it has the added appeal of having three investment narratives at the moment. It's a risk asset that arguably is one of the more sensitive to liquidity conditions because it doesn't have to worry about revenues that might be hit or cash flow that might be hurt, you might have to try and contain, etc., etc. It doesn't have to worry about rising costs. Bitcoin is pure liquidity sensitive on the macro narrative. So if indeed we are going to get more liquidity conditions, or even if it's just sentiment that drives it, or even if new leverage comes into the market, that should benefit Bitcoin. But Bitcoin is also, as we talked about, the safety asset, as in it's going to do what it's going to do, whatever governments decide to do with banking access or free speech or military alliances or trade relationships or anything like that. Bitcoin's just going to do what it's going to do. And then what many people are still also looking, the third narrative, and this is not fully valued yet, is that it is an emerging technology. Bitcoin is not finished in terms of its development. The network itself does not change easily. It is pretty set in stone. It would take a lot of, it would be something quite massive to get everyone in the network to agree on a code change. But there is so much going on around Bitcoin, layer twos that are emerging, new types of services, apps, on-chain lending for Bitcoin. Michael Saylor is apparently working on decentralized identity on the Bitcoin blockchain. There are many uses for block space at the moment that are not fully priced in. This is very nascent, but there are very few assets out there that can actually fill those three narratives. So I'm defensive, but I also am exposed to some risk sentiment, and I am exposed to the development of new technologies.
Yeah, that's a sort of great way to categorize it and think about it. And I think for all of us, when we're thinking about it, one of the things that reminds me of, and that we've talked about a lot with traders and with managers, is to sort of know your risk, right? So you can get specific on assets and diversification, but first you've got to gut check what kind of risk you feel like you can tolerate, especially in the short term. And someone just reminded me that we all say we're long-term investors, but we actually psychologically pay attention attention to the short term. So you've got to
We're
lock in on
human.
that when
Yeah,
you're,
we're human.
yeah,
And
we're human.
we all suffer from recency bias, even though we know we don't. We tell ourselves we don't. We'll tell but we do. We all suffer from recency bias, which is why it's interesting to look at, okay, what is keeping things down, or what is keeping things going. Often
Yeah.
it's just because it's been going for a while, or because it hasn't. Inertia has a way of just continuing a momentum.
Yeah. I love that folks in the chat are trading some of their trade ideas that they're operating on with at the moment. We've got some real sharks in here. It's fantastic. I did want to squeeze in one last question because it was a two-parter from J&J, and that was about ETH as well. The ETH ETF. What are you thinking about in terms of, Bitcoin relative to ETH? Has the ETF been going as well as hoped? I know there's been a little disappointment around the entire ETH ecosystem, I think, in general. What are your thoughts there?
ETH does not have the same tailwinds accumulating behind it that Bitcoin does. But that said, it's been pretty battered in terms of relative performance. So if I were a trader, and I'm not trading advice, I would not be selling here. But there is a time coming up soon when it might be worth starting to buy. Although, again, it doesn't have the same tailwinds. The ETF, it's just not a great product. It's a good on-ramp, it's convenient, but it does not distribute staking yields. And staking at the moment is liquid enough that there isn't really a liquidity cost to staking. It would take just a few minutes to unstake. Of course, that can change on a dime should the market get kind of crazy. But right now, you put your money into an ETH ETF, you're losing maybe 4% yield there, which for some retail investors, that's a convenience cost. But for others, it's something they would have to explain. So again, it's not a great product. It will never do what the Bitcoin ETF did, which arguably was, the most successful ETF launch of all time. But that said, there is just still a lot of development going on ETH. ETH, it does have very active layer twos. Most of the value accrues to the layer two tokens, that's true, but it will eventually trickle down, and the ecosystem brings value one way or another. That said, Bitcoin has the much more obvious tailwinds at the moment, but I wouldn't rule ETH out totally. And another strange thing about ETH that is not so easy to understand, and that is the more use of ETH on its blockchain, the lower the new supply. It's recursive. If ETH is doing very well in terms of transactions, ETH fees are burned. The net new supply comes down, which would tighten the supply at a time more demand is coming in to trigger those transactions to bring the new supply down further, and so on, and you do get an upward spiral. When we could see that, or why we would see that kind of trigger of a whole lot of new transactions, to be honest, I don't know. But ETH has definitely been lagging. I'm seeing a lot of people also just simply confess, I don't understand it. What does ETH even do? Bitcoin, hard to understand also because you have all these different narratives that we've been talking about. But ETH, it's a store of value, it's a payment mechanism, it's an app store. There are a lot of different narratives that for many investors used to macro thinking, they just don't really understand it. That said, ETH is DeFi, really. If you believe in the DeFi ecosystem, ETH is a good way to get exposure to whatever is going to end up working in that ecosystem. And for many investors, they understand yield.
I love it. By the way, that was No One Knows Thyself, not J&J, who asked that question. I'm just going to clarify that. But I think it's so fantastic because Christopher just said he's just not going to be in Bitcoin. He called himself something hilarious. I can't find it now, but an old knuckle dragger, I think. But listen, it may not be for you. But from my perspective, I still want to learn about this and I still want to know what's going on. And Noelle, you have always been a fantastic resource for me when I'm trying to understand, I think, really the technology behind all this. And as you said, it is new. You may not be touching it now. It may be out of your risk profile, but that doesn't mean at some point things won't progress or there won't be some development. So I just think it's a sort of fantastic way to just keep up on it. And you are just all over it. You mentioned something Sony's doing. So many tie-ins to the real world, which for me is interesting to see, what companies and the private sector is doing in that sandbox. There's an awful lot that's going on that, as you mentioned, is not getting picked up in the macro. And the narratives I'm going to pass along to Brent Donnelly because I just tweeted out from our conversation, from his trading perspective, he's like, I don't see the narrative. But again, time horizon matters, right? So short term, that's what he was thinking. you mentioned these longer term stories and tailwinds
Yeah.
that are pushing it. So
Yeah.
maybe not as much light in between the two opinions
Also, short
as we think.
time frame does matter, but also where you are looking at it from matters a lot. If you are in a very comfortable financial system, it's hard to imagine people with less access to easy payments or savings. It's hard to imagine what they would be going through. And I have had so many conversations with traditional investors, Maggie, that they don't get the point. Bitcoin has no use. It's, what's the point? Everything works fine. Why do we need this? Well,
Mm.
again, for most of the world, that's not the case. And another overlooked point to make about Bitcoin is that one Bitcoin in Seattle is exactly the same asset as a Bitcoin in Bangladesh or a Bitcoin in Haiti or a Bitcoin in Pretoria. So that is, again, there are few assets that are exactly the same all around the world, and something as versatile and new as Bitcoin is different things to different people depending on where they are.
Yeah, fantastic point. I just think it's fascinating. As with any time there are sort of new developments, I just think it's great to stay on top of them, even if you don't feel like investing them as a student of life. It's good to dive in and make sure we know what's going on. Fantastic conversation. J&J, by the way, calling out your setup, saying it looks so great, Noelle, and we
Oh, Judy,
agree.
thank you. Been working on it. It's not as easy as it looks getting this going, but trial and error. Thank you.
Oh, it's great stuff. Thank you so much. Always great to catch up with Noelle. Again, you can see her work on the Crypto is Macro newsletter in Substack. And thanks from all of you in the chat. Super engaging today. I love it. We did a poll, by the way. Ringo did a poll and was asking about the Fed rate cut. What do you think? Oh no, I just lost it. I think most of you were thinking 25 basis points. I mean, it was pretty set, like 75% of you were thinking it was that. Although it was creeping up. So a couple people out there expecting 50.
Yeah,
Of course, we'll get
I
that
kind
decision
of,
on Wednesday.
yeah, I'm hoping it's 25. But again, I keep wondering why plant those. I'm not saying the Fed planted those articles, but
Oh, I think we
something
can.
went
I
out.
think we
Something went
can.
out.
Yeah, I think we
Why
can.
send that message out on Friday? I don't know. I'm worried we're going to be very surprised on Wednesday, and I have no idea how the markets are going to react.
All right. Beware the initial reaction, I think,
Yeah,
as
yeah,
well.
always, always.
Because we often see that settle in. But we'll be talking about it. I'm going to be on with Peter Bookfar, and might be popping up all over the place on Wednesday,
Awesome.
since it's such
I'll
a
tune
busy
into
time.
that for sure. I'm not going to miss that.
All right. Thanks so much. Thanks everybody. Great to be with you all. As always, take care and good luck out there.